Hey Jay, our returning champion, Jay Petricelli from Zega Financial. Welcome back to the channel. How are you doing, my friend?
I'm doing well. So glad to be back. Thanks for inviting me.
Yeah, sorry, my lighting is a bit low. It's very dark here in Panama because it's actually raining for once, which is good because we've been having kind of a drought anyway. So it's good to do a follow-up. You guys have been very busy. I love your products. I've been tracking them very closely. We're gonna talk about all the new ones that just came out. You launched a bunch of new ones out, and you've been very busy. You've been on many YouTube channels. I've seen a few of the interviews, a few of the Q&As, but of course, nothing will beat our original interview where it
Yes,
just
you're the
passed.
original. You were the first that we did. So thank you.
No problem. You're very welcome, and hopefully we'll do this again sometime. So today we'll talk about kind of like a follow up. And in case my audience doesn't know, we've already done a video together where we talk about these ETFs in detail. And here's a thumbnail here. You'll see that here. Of course, at that time only ARK and Tesla was out, but in case my audience is not familiar with these products and how they work, how these ETFs work. We talk all about it in this video here, so check it out. In this video, we're going to talk a little bit about the newer ETFs and maybe some harder questions regarding the covered call strategy. So tell me about the new launches. I mean, you guys had a lot. So if I just share my screen, and you guys are constantly launching them as well.
Yep.
So last time we spoke, you had ARK, OARK, which does cover calls on Kathy Wood's flagship ARK fund. You have Tesla, which is Tesla. Now you have Apple, you have an Nvidia one, an Amazon one, a Google one, Facebook or Meta, Netflix, Coinbase. And as per your Twitter, which I have to say you guys have a really good team because you're always letting us know what's coming, Microsoft and Disney are next. Those are the ones that are coming out next. So my question to you is, how are these companies, how are you guys selecting the companies to do the next YieldMax
Yeah, that's
ETF? Go ahead, sorry.
I was gonna say it's a great question because right there's so many stocks that we can
Yeah,
take a look for. So the criteria is fairly simple. We're looking for stocks that have a healthy options market. We're looking for stocks that have a healthy implied volatility, right? As you remember, that's a big driver of the yield that we're able to produce in the ETFs. We're looking for also popular stocks, right? Popular tickers, right? Going with Tesla and ARK as our first ones, obviously had to do with the popularity of those, and then of course Nvidia, Apple being the most widely held stock, right? Those that was a lot of the determining factor for us because we want to make, as you may recall, we want to really appeal to at least some of our investors that are already holding some of the underlying stock. They could add some of us in to kind of give themselves a little boost in yield or even get some yield at it, but still holding the same underlying tickers. Those, as you know, we always talk about, you have to at least have an idea about the stock before you buy the ETF that they're based on, right? You want to
of
be
course.
at least not bearish, I should say, right? So if you're bearish on a ticker, so we don't like to go with the thinly held stocks, even if they have a lot of volatility and they have an active options market. While we're not making a prediction on what the stocks are going to do, we still want to pick ones that are popular amongst investors.
Yeah, and we did talk about this at length in the previous video. If you gotta like the underlying, if you're investing in the Tesla, an OARK, or the Nvidia one, you're still investing synthetically. But you guys are not actually holding the underlying. You're doing it synthetically, but it's pretty much follows the price of that stock. So it's kind of like you're investing in that stock. You gotta like the stock. That's what you're really investing in. But you guys are writing very aggressive covered calls. I don't know if aggressive is the right word, but a lot of covered
Yeah,
calls, which we're going
I'm
to
not
talk
sure an
about.
aggressive covered call would look like, right? But you're right. So we are trying to generate premiums that
Premium, yeah.
create the high yield. Yes, that's right.
Yeah. And just before we get into that, I just want to look at the latest prospectus here that I found. And you guys are launching a bunch more. So we got a lot more coming. We have MicroStrategy, Alibaba, Airbnb, AMD, which is kind of like Nvidia's competitor, I guess. mRNA, that's Moderna, I believe,
Yep.
pharmaceutical. You have PayPal, you have Disney and Microsoft, which are coming up really soon, as per your tweet there. JP Morgan, ExxonMobil. So this is really awesome. So you guys are, as far as I could tell, it's really quality blue chip stocks in America, big stocks that probably, like you just said, have big options market, right? And that helps with the covered call writing. So my first question, my first important question, is tell me a little bit about how you guys, or a month in the life of a YieldMax ETF. Because to generate such substantial yields of 30, 40, 50, or even higher, I don't think you're just writing one call a month and just cycling it. These are, correct me if I'm wrong here, weekly calls. So how does, I want to like be in, how could I say this? Tell me the cycle or the process of in
Yeah.
1 month of any YieldMax product.
Yeah, absolutely. Sure. So this is all information that, is in the prospectus. We will look to sell calls that may be less than a month. Typically, like you're right, we'll sell 1 week out calls. We want to be a little out of the money, right? On a monthly basis, 5 to 15% out of the money so that we capture some of the upside moves. So we will look at calls each week and say, okay, where can I get out of the money and earn a premium that is kind of commensurate with the implied volatility? So let's take, for example, the most popular one, Tesla,
Yeah.
right? That one has the most assets in it. So I'm happy to use that as an example. So when you look at Tesla, right, and we're looking at the options within Tesla, we're using the Tesla options. We will look at doing, say, 1 week out, but its implied volatility right now is around 50. So what we'll do is we'll say, can I get far enough out of the money and still generate enough income to produce a yield that is around that implied volatility of 50? Now, because we're out of the money, it means we might come in a little less at like maybe
Yeah.
a 45% on an annualized basis. So we will actually look at those 1 week calls. Now, once we're in the call, let's say we sell a call that's 4%, 5% out of the money, and on an annualized basis, it's going to generate 50% for us, right? So let's say it's just under 1% per week, like quick math, right? 52 weeks, 50%. I'm going to round to 1%.
Yeah.
In that scenario, if the stock goes down, right, from where we got in, that call is going to depreciate. It's important for us to have the call depreciate in time value because the entire strategy is based off of earning time decay, right? So we're trying to earn, in the options world, we call it theta, but we just know that, every day option values decay based on the passage of time. So if all else was the same, meaning the stock didn't move, option values would drop because time goes on. That is actually the only thing, I like to say we can guarantee that today comes out, tomorrow comes after today. So we get to earn money by selling options. And so let's say that as the stock drops, that time decay accelerates, right? All of the juice falls out of those options. We'll then actually cover buy those options and do a new one. So let's say after 4 days that we're in the option, the Tesla stock drops. The call that we sold for 1% is now, trading at, let's say 1/10 of that amount. We'll buy it back and sell another call. Now, we'll also look to go out, either whether it's that week, sometimes we have to go out to the next week. So let's say it's 6 or 7 days out, we'll market days, we'll sell the next call that generates the right amount of premium for us. That's an annualized 50% and is far enough out of the money to make sure that we capture some of the upside. So that's kind of the process when the stock's on the downslide. When the stock's on an up move, things got a little different because the stock can go through your short call. Now, that's
Yeah.
not the worst thing in the world for any covered call seller because you've maxed out your possible gain. It's good to have a max out return, right? You made some of the upside of the stock and you made all your time premium on that call, right? So we will, again, same concept, wait till the time value is zero, not waiting till the option is zero, waiting till the time value is zero. Then we'll cover buy that call and we'll sell another one. So it's really all about earning time decay. Whether the stock goes up and down is one thing, but the most important part about selling those calls is letting the time value come out of it.
Absolutely incredible. I'm learning always when speaking to you. I didn't even know that you had weekly options. So I love covered calls. It's a bread and butter of my portfolio, my strategy, but I've never actually sold a call in my life. I thought, 30 days is the earliest one, but you guys are actually, you could do weekly calls. And it sounds to me like what I'm hearing is this is really active management. This is not passive call writing. This is you're
Right.
really looking. You're doing different things. If the stock price is going down, you're doing different things. If the stock price is going up, this is always what I want to hear from my covered call manager that you're paying the fee for active management because you have a dynamic approach so you could capitalize on what the stock is doing, whether up or down. And you guys are always doing out of the money calls, right? Is correct
Are
me
we
if I'm
selling
wrong
out of the
there?
money calls? Yep.
Selling out of the
Yep.
money calls, which means, and I think from the prospectus, it's 5 to 10%. So you're always gaining, and no matter what call you're writing, there's always some upside, which is very important as well. So very, very interesting strategy. Now, correct me if I'm wrong here. So when you're earning all those premiums every week, every month, that gets added to the NAV or the net asset value of the fund. And then when it's time for the X dividend date, it gets subtracted from the NAV because it's being paid out as a distribution, right? Do I have that correct?
You definitely have that correct. So
Okay.
that's exactly right. So when we have profits from the covered calls, those profits are reflected in the NAV change, right? So that's why
Yeah.
on like down days, you won't see like Tesla versus Tesla. On a down day, you typically will see Tesla down more than Tesla because
Yes.
we earned a little value on that short call.
Because
And
it's
on
not
big
going to be
up days,
exercised.
that's
Basically,
right.
there's less chance of it being exercised when the price goes down. Is as a covered call manager, there's more of a chance it's going to expire worthless, which is what you want.
Yep, right. Yeah, that's when we say the value of the option itself drops, which means right. So it's almost like we're short selling the call, right? When you short a call, we're selling that call. You sell it for a price, and you want it to go down, right? If I sell for $1, I want to get out of that thing at somewhere around a dime or less, right? Because I want to make money as it drops. And the way that that call drops is time decay passes or the stock goes down, right?
Yeah.
That's the way that that option then will drop. So that's why you will see the profitability, even if we don't close the position out, you'll see the change in the NAV reflect the profitability of the change of that call, right? The profit of that call. So yeah, I mean, all of those gains are reflected. And then once, I'm doing a little like stair step here because we sold the call, sold the call, sold the call, sold the call, and then we distribute the profits from that call, right? That being the stock, the ETF price, and then we'll drop, and then we'll start to do it again. That's if the underlying doesn't move at all. Of course, we know Tesla, ARK, NVIDIA, Apple, they all move, so that also then that synthetic component changes the value of the NAV as well. But if the stocks were to remain flat and we sold calls, let's just say 1% a week, you would see us step up to 4% higher and then distribute 4% out.
Yeah, very, very interesting. This is why I love the cover call strategy because on the down, if things are going down, I'm happy, I'm okay because you have that cushion. Things are going up, you're also capturing upside, not as much, fine. But so up or down, I'm okay, I'm happy. This is why I love this style of investing. So thanks for that explanation. I just want to confirm something. So, these are 5 to 10% out of the money calls. Are you doing it? And I'm pretty sure the answer is yes, because I remember asking you last time. Are we covering the whole portfolio, 100% coverage?
Yes, so it's a great question because I think we covered it last time, and I did say 100%, and that's true. Our goal is to always have 100% of short calls on. By the way,
Okay.
the funds are not leveraged, right? Let's also bring that
Right.
up. Sometimes people miss that. They go, "Oh, you're a single stock, you must be leveraged." We're not. We don't leverage. We just do notional value. So we will generally be covered on 100% of the portfolio, not half, like I know some funds do.
Yeah.
But sometimes while we're doing the active management and we cover a call, we may decide to resell the call, a new call the next day. So there could be a period of a day. I think we've only ever gone a day where we haven't, fully sold calls in the
Hmm.
portfolio. So there could be very short periods of time where the active management leaves us partially covered and partially uncovered. And look, in those scenarios, if the stock goes up, great. It means I end up selling a call. It's not usually a market determination that drives that decision, though, right? We take off the calls when the time decay is dropped. We get into the new calls when they meet our criteria, right? We want to make sure we can get far enough out of the money to meet our 5 to 15%. And we also want to make sure that the income we're generating from that call meets our target that we have that's tied to the implied volatility. There are times where the volatility is just so low that, giving it a day or two, right, to let the stock move might make sense because then we could still meet our target returns. And then there's flip side, like let's take right before earnings,
Yeah.
where volatility can be very, very large, right? Certainly in a ticker like NVIDIA and Tesla, you can get large movements, and there's a lot of implied volatility in those options going into earnings. In those scenarios, we may go even farther out because we're getting more than we think we need, right? So we may go 15% in a single week or 12% in a single week versus the whole month of 5 to 15%. Or we'll say, look, let's make a little more than what the implied volatility is giving us the opportunity to, because there's just so much more extra juice and premium in those options. So yeah, again, that's all the active management stuff,
Active
but
management. Yeah.
that's all the things that kind of go into the mix for what we do versus, being more robotic of selling at the money every month, right at expiration. Everybody sees those trades coming. There's not a lot of a discretion when it comes to those, and that's okay because it may mean more predictability.
Yeah.
Whereas our yields do fluctuate quite a bit, but we're always looking to push them as high as we can.
Okay. Okay. And my another question I had, yeah, active management. It sounds like you guys have it down packed. You know exactly what's going on. That's great. So do you give out, so all the premiums you're making, are you giving out all of that at every month, or are you reinvesting some of it? How does the how is the distribution percentage? Is it I'm just going to give out all the premium I get every single month to you? Obviously, it's called YieldMax, right? So yield is
Yeah.
the main mission. So how do you guys decide how to
You
do that?
know, yeah, with what I can tell you here, right? And this is always subject to a little discretion.
Yeah.
We do our intention and our goal is to distribute what we've earned from selling the calls, right? So
Okay.
I don't want to say 100% of the time we'll always do that. I could probably think of a scenario where we might hold some back. I could think of a scenario where we might distribute the gains of the synthetic as it moves up too, right? Sometimes we might be able to earn some gains as we roll the synthetic, as options expire for us every 3 months or so. Sometimes we'll have gains, sometimes we'll have losses in the movement of the synthetic just because the stock has moved, right?
Yeah.
Sometimes we'll distribute that, sometimes we'll hold that back. So it's a little bit of there's definitely some discretion involved in there, and has to do with fund accounting. But I would say in general, our intention is to distribute the gains we earned from selling calls and earning the time decay.
Yeah, correct me if I'm wrong here, and this is for my audience, just in case they haven't seen the first video, they don't know what you're talking about when it comes to synthetic. I would imagine there's really three sources of income with this product. Number one, the cash is in mostly short-term treasury, so you have a little bit of yield there. That is an advantage of doing the synthetic strategy and not holding the Tesla. You have cash to
Right.
put in other things, which now there's some great yield with those short US treasuries. That's number one. Number two is obviously the call writing. That's obviously going to be the biggest portion, I believe, pretty sure. And what you mentioned before, just now, the synthetic. So you guys are not holding the Tesla, you're not holding the Nvidia, you're synthetically holding it, which means you're buying a call and I believe selling a put at the
That's right.
exact same price. So it's like you are invested in Tesla or Nvidia, but not directly. Is that correct? So
Yeah, you're 100% correct, right? That
okay,
that synthetic combo, we like to say, is 100 delta position, right? So all that
yeah,
means is when the stock moves, 1%, that synthetic should move 1%, both up and down, right?
right,
That's why we like to say, when people ask us what's the risk, what's the catch on this thing? It
of
seems way
course,
too good to be true if you're distributing 40, 50, 60%.
yeah,
And the answer is you're taking the risk of the underlying stock like any covered call strategy would. So that synthetic has 100 delta. So as the stock drops, so will our fund, offset a little bit by what we earned on the short call, as we talked about earlier. But you're right; it's that synthetic is a long call with a short put at the same strike. That we don't have to go into a synthetic class. The word synthetic sounds really kind of intimidating. It's not. Just
no,
think of it as replicating stock exposure, and
yeah.
that's a long call with a short put, and that's it, right? That's we try to
Why do
keep.
why do I have the feeling that a lot of people are going to start copying the synthetic strategy, especially now because you could get so much yield? What's the point of owning the underlying? Just do it synthetically and get an extra 4 or 5% yield, which it gets added to the fund. Anyway, I think it's a no-brainer.
I
I
mean,
think it's very
that's our
smart.
theory. We're with you, right? Like take advantage of higher rates and use treasuries in the portfolio, right?
Yeah,
So
exactly, exactly. And you'll see that if you go to any one of your ETFs, and I showed this in the first video when I was reviewing it, you go to holdings, like more than 90% are in those bonds, those short term. That's the cash or the assets for the fund. And you're making yield off of that also. So the calls are giving you big premiums. You're getting a little bit of yield from that. It's absolutely great. So, okay, so I have an important question for you now. So
okay.
this is, I get this question from more experienced investors and I have it myself. So I might not know how to ask this question properly, but I'm going to do my best. I know you'll understand what I'm talking about. So calls are out of the money to capture some upside. You're capturing all the downside. So this is very typical with cover call strategies. You're capping your upside, but you're getting the full downside all the time. So if we look at Tesla, for example, the Tesla one, you kind of see, when Tesla drops like a rock, Tesla will drop like a rock also. It's only normal. But
Sure.
then when it goes back up, you're not really capturing all of it. And then if it drops like a rock again, you're capturing all of it. So like people are worried that you're just going to have this downtrend going all the way, all the way, all the way down to oblivion. And that's why my earlier question was, do you reinvest some of it or do you give it all out? For example, there's Global X with QYLD, very, very popular. They do at the money 100% coverage, but they only give out 1%. The rest gets reinvested, right? So in this case, in the yield max, it's a bit different. You're giving out mostly. So is there a risk? How do you address the concern that investors have of that long-term depreciation? Because correct me if I'm wrong, if the NAV keeps going down and down and down, the call option premiums you're not are going to go down also, right? Because you have less money in the fund, unless that's my mistake and I'm not interpreting it properly. How would you answer this concern? I hope I'm making sense in what I'm trying to
Yeah,
say.
no, well, you're making perfect sense. You've identified the risk of any covered call strategy. Absolutely. QILD has the same risk. Yes, they hold back a little bit on their monthly, but they
Yeah.
capture even less on the way up, right? So
Yes.
let's picture how this is used in a portfolio. I will say your assessment is correct that you limit the upside and we had all the downside minus
Yeah.
the covered call cushion, right? And so if a stock is really volatile, we'll
Exactly.
only, we'll keep bouncing our head up off the top and then get all the downside, then less on the top. So that is absolutely the number one risk of any covered call strategy. We experience that just as well in YieldMax. So when you think about the goal of YieldMax, right? So I want to address your question, but I also want to address why you would have it in the first place. Think of YieldMax not as a, hey, I want to get long Tesla, but this is a better way to do it because I'm going to get paid to do it. You can't capture all the upside, right? We never talk about that. Any of the yield maxes will outperform the underlying because they really can't over time for the exact reasons you just mentioned. Think about yield max as a way of generating alternative income, right? So you talk a lot about yield and on your channel, and when you think about what option income is and where it should fit in a portfolio, it should fit in the alternative category,
Yeah.
right? I think of yield max as an alternative to stocks or bonds, right? It's a way of generating option premium. We just happen to use Tesla or an Nvidia or Apple as the underlying vehicle to generate that alternative income. So, do you take risk of the underlying? Yes, we always talk about that as the risk. But look, if Tesla's going to go down, we started the conversation saying like you can't, like a dropping Tesla is bad for this strategy, right? So if you don't believe in Tesla, then you should really think twice about buying Tesla, unless you're going to buy it and hedge it, and that's probably a whole nother conversation. So if you're worried about too much volatility like a Tesla or an Nvidia, go with the Apples and the Microsofts of the yield max world because you're going to take away some of that downside risk. Look, Apple just went from 200 to 175 in a pretty short period of time after earnings. That's a decent drop for Apple,
For
right?
Apple, yeah.
But for Tesla, it's like, whatever. That's just
Yeah.
a mediocre month, right? Tesla could be down 25% in a single month. That's happened multiple times. And so you're right. So while it's part of the reason why we're active, because we don't want to, limit that upside as much as we can. We want to capture as much yield as we can. So when the stock's on the downslide, we're selling calls on the way down, but we like to give ourselves that out of the money gap. So when the market does have an upside move, we're capturing some of that. And the theory here is, yes, we'll generate enough yield over time that when you reinvest those dividends, you're keeping your portfolio at a similar size as when you started, and your share count goes up, which means your dividends will go up. Now, your last part of the question is, hey, this thing's just going to get dividended out and yielded out to zero over time.
Yeah.
I don't necessarily think that's the case. It all depends on the underlying, what the underlying
Right.
is going to do, right? So, like any derivative ETF, and the covered call piece, we carry all of that downside risk. I do think it's fair to say that if you're actively, doing a drip program and reinvesting, that you can help avoid some of that decline in your position value. That is
Yeah.
one of the ways that we recommend folks use the YieldMax ETFs. But you're not wrong on assessing the risk. This is not, the holy grail of investing. It is for the investor looking for alternative income, and it's a new and innovative way to do it. But it's certainly not risk less.
Yeah. Yeah. You got to be, I always tell people, you got to be responsible, right? You have to understand what you're investing in. Just don't look at Tesla and say, 50, 60% yield and put all your money in that. Like, that's not something I would do. Reinvest some of your distributions, get a mix of them, get the Apple one as well, which is much, much less volatile than Tesla. So obviously we have to be responsible investors. And like you said, this is really carries the same risk that most of all covered call strategies do, and some covered call strategies do at the money. This one is out of the money, so you even have some of that upside. And what really gives me comfort, honestly, is the active management part, because you're always looking and you're adjusting instead of a covered call manager who just does the same systematic approach. Here's a quick question for you, just randomly like that. Let's take Tesla, because that's I feel or maybe even the Coinbase ones that are
Sure.
really have a lot of volatility.
Right.
If let's say they're doing that thing that you said, you're hitting your head against the wall, but you're going all the way down. Would you guys consider, because obviously you're fund managers, let's be honest here, you're making fees. You want these funds not to go to zero and to keep going. Would would you consider maybe reinvesting some of that covered call income, let's say, to boost up the NAV at one point instead of giving it all out? Like, do you see that as a possibility in your active management approach?
So I'll say it's a maybe. Like I said, right? It's not. We're not going to always. I don't know for sure we'll always distribute 100% of the calls, but there is a little bit of a thing to remember here with ETFs, where of the gains you realize each year, you must distribute at least 90% of that, right? That's kind of the rules of ETF. So even if I held it all back, I'm going to eventually have to pay out 90% of what we've earned there. So it's really just a sliver that we can keep. And for
Okay.
me, I think I'd rather, distribute so that investors can reinvest and add to their share count and compound their share count versus say, well, we'll hold on to it in case, we want to keep the NAV a little more stable. Look, I think there's an argument both way on this, but regardless, by the time the year's over, we're going to have to distribute most of it anyway.
Listen, man, I could talk to you all day, to be honest with you. You're a very smart guy. You obviously have mastered these calls and the strategy. I think you guys are doing a good job. And again, like last time, I don't want to keep you here all day. I do have just a couple of extra questions,
Sure.
which I got from some viewers, and I thought were very interesting. So what about, as you guys are doing single stocks, or you're doing ETFs? I really like the ETFs, by the way. So far, you have just ARK, but you have a biotech one and a gold one, I believe, in the prospectus as well. Can't wait for those. What about just doing this on the S&P 500 or the Nasdaq, the SPX or the NDX? Have you guys thought about that? Consider that YieldMax Nasdaq 100, YieldMax S&P 500, Russell 2000. Are you thinking about that, or are you just sticking with the stocks that have very high volatility?
Yeah, it's something the YieldMax brand has discussed, and today we haven't filed for anything for like a YieldMax version of the S&P 500 or the Nasdaq 100. But we discuss a lot of different ideas, and where we've leaned so far, as you could tell, most of what we've gone live with are single stocks.
Yeah.
We're like I feel like we've kind of cracked into like a little bit of an innovative way of giving people access to single tickers with the option income over them, right? So for us so far, that has been the focus, where we are looking at the single stocks as our priority, but look for additional filings down the road. But so far we haven't filed anything on the S&P or the Russell or the Nasdaq.
Okay, fair enough, fair enough. Let's keep an open mind. That excites me very much. If you guys would do that, I'm sure for my audience as well. Last but not least, I think we discussed this last time. I have to ask. I know you can't answer, but I'm still gonna ask. What about a wrapper that has all of them? All your YieldMax, an all-in-one, all together. So someone who, obviously these are great because if you like Apple, you get the Apple. If you like Amazon, you get the Amazon. You don't like Tesla, you could kind of build your own. But what if we're talking about more of a really hands-off passive investor that does not want to choose, loves the strategy? Just give me an ETF with all of them. You choose the percentage. If there's a new one that comes out, add it in there. I would be more than happy with that, because the average yield would probably be very high in the 20s or 30s even. Have you guys considered that as well?
Yes, absolutely. We're considering almost like right, an ETF of ETFs, right? With our
Yes,
ETFs, where we handle the reinvestment and we handle the allocation, right? I mean, look, you talk about passive investing, right? That's important, right? And so when I talk about, hey, you should be reinvesting, you have to go in and you got to do that on your own if your broker doesn't have it set up for you. So
exactly.
this is almost like we're taking kind of a passive option strategy and then making it even more passive, which I love the idea. I think it's something that you'll see in future filings for us as well. It's absolutely something we've talked about. We get that request all the time, right? Especially now that we have, 9, 11, soon we'll have 15, maybe by the end of the year, 20. it would just be easier for us to do that for folks versus having everybody to do on their own. So we think that's also probably something that will be filed for down
I'm
the road.
super excited, my friend, for that. And you could even do two versions: an income version where the income gets out, a growth version where it gets all reinvested, and you could use that as a growth vehicle as well.
Are
So
you sure you're not a portfolio manager? Are
I
you
wish
trying?
I was. Like
You
if I
got it
would go
right.
if I would go back 20 years, I would have definitely went in finance instead of tech. But I wasn't that great in math, and that's why anyway,
You
it's a
seem
different
pretty good to
story.
me. You seem
Yeah.
like you got a good handle on it.
It gets with experience and time, and especially, having a big audience and knowing what they want and need, you kind of start knowing and understanding the products and how they work. And this stuff fascinates me. That's why I love talking to guys like you who are just innovating in the field of options and the stock market and portfolio management. So it's awesome. It's really, really great. It's great having you again, my friend. Thanks so much for doing this. Looking forward to all the new launches and the new innovation that's coming out here. Very, very exciting stuff. And come back anytime. You're more than welcome. And we'll talk soon.
Thanks so much for having me. As always, we'll definitely stay in touch.
Yeah, take care. Hey, don't go yet. A few reminders before you leave. Did you know that I launched a YouTube loyalty membership program where for only $3 a month, you could become a PII Inner Circle member, where you will gain access to exclusive content, exclusive videos and live streams, as well as other perks and benefits, including a really cool weekly opportunity report. That's right. If you're interested, just click on the little join button next to the subscribe button to see what it's all about. Also, make sure to follow me on Blossom and download Blossom. It's a social investing app, which is really cool. You could share your portfolio, follow other people's portfolios, including my own. My username is Adrian_PII. So download it with the referral link below. Not only is it free, but you could actually earn cash by taking these really small, quick 1-minute courses. Really awesome. It's a no-brainer. Also, make sure to visit our website, passiveincomeinvesting.ca. That's where you could book a one-on-one private coaching session with yours truly, with myself, where you could ask me all the questions you want. All the information and booking information is on the website. Make sure to check out that video on the homepage there to see how to book a one-on-one properly. Also on my website, you could purchase my digital product, which I'm very proud of, the ultimate DIY investing package. This is a reference tool or a companion tool that will help you build your own portfolio. So it has lists of funds, it has sample portfolios, and it covers both the Canadian and US stock markets. And the good news is you'll only ever have to buy it once, because it comes with free lifetime updates. And my plan is really to update the version every single year. So make sure to pick it up. Also, I have Questrade and PASSIV referral links below. So Questrade is the broker that I personally use, and PASSIV is the broker companion tool or assistant that I use. Really cool program, really cool software. So I have referral links for both of those. Questrade, $50 of free trades. And PASSIV, I have half off for the elite membership. If you're interested in the elite membership, and even if you want to start out with the free membership and upgrade to the elite afterwards, use my referral code so you could still get that 50% off. And don't forget that the elite membership of PASSIV is 100% free if you use Questrade. For social media, we have a very successful and big Facebook group, private Facebook group with over 14,000 members, where we all try to help each other out. So make sure to join that group. Information is below. We also have Instagram, where you could follow us, or more personal stuff when it comes to our life here in Panama. And there's LinkedIn as well. So as usual, everyone, how do I leave you? Continue to stay safe, stay healthy, and of course, stay passive. See you next time.